Welcome to the Third Row Tesla podcast. This is Safi and Fraval. Today we have a very special guest. I think you're really going to enjoy this one, as all of our guests are really special. So I'll introduce our crew and then our special guest. So we have Viv.
Hey, guys.
And then we got Gally.
What up, Third Row?
And then we got Omar.
Boom.
Boom. And then we got Kristen, K10.
Hey.
And then we got Vincent.
Hello.
Hey, man. So we got our full crew. And so today we got our special guest. We got Rob Maurer from Tesla Daily Podcast. How you doing, Rob?
Hey, guys. Thanks for having me. Doing well.
Excellent. It's a pleasure to have you. So we're going to cover some of Tesla finances today. And I guess, maybe you want to give a little bit of background to anyone who doesn't watch your podcast, but maybe recap for those that do as well.
Sure. Yeah. So the podcast is called Tesla Daily. I've been doing it for about 2.5 years now. And really, I started it just as a way to help keep people informed because the news flow for Tesla is just so, rapid and kind of out of control sometimes. And there's always a lot of context that is missing from sort of like the mainstream media. So really, what I aimed to do when I started the podcast was just kind of fill that in and, get more accurate information out there and provide people with context that maybe other media sources are missing. So I've been doing that for a couple of years now, and slowly over time have gained a following, and now I'm doing that full time, doing YouTube and stuff like that. So yeah, it's been an interesting journey. Never a dull moment with Tesla, as we have seen this week.
Yeah, definitely. And I just want to say about your YouTube, I'm really impressed because I've been following your podcast for a long time, and since you made the switch to YouTube, I've been really happy you did that. So that was a great move, being able to get the visual feedback.
Yeah, I got to thank Gally on that because he's been pushing me for that for a long time.
Awesome.
Yeah, it's crazy. YouTube is just such a big social network. People don't really think about it that way, but there's just so many people, probably more than Netflix or anything else, obviously.
Yeah, I think it's the second biggest search engine to Google.
I was like, Rob, what? You're missing the biggest podcast platform. That's YouTube.
Yeah. Yeah, well, it's tough with podcasts because there's no discoverability. Like, the only way that people would find out about the podcast when it wasn't on YouTube was just through basically word of mouth. Because, you go into Apple Podcasts or whatever podcast app you have, and it's not really recommending anything. Versus you go on YouTube and it's just like constantly shoving things in your face. So trying to ride that tailwind of YouTube helping me out with that. So yeah, it's been good.
Yeah, totally.
And for those of you who haven't checked out Rob's podcast, it's really great if, you need something to listen to every day. Probably the best thing out there if you're just looking for, if you have a commute every day or something and want to get updated on Tesla stuff, he always sums it up really well.
Yeah, I've been really impressed just like how quickly you got the episode out.
Yeah, and it's usually only about 10 minutes too, so it's like pretty quick, 15 minutes max. So it's, listen on 1.5 speed, you can pretty much stay up to date in Tesla in like 7 minutes a day. So that's kind of the goal for it.
Yeah, and we'll put some links down in the show notes so people can go directly to your podcast and find you. So I guess one of the things I want to start off with is kind of the elephant in the room everybody's talking about on Twitter. I think we should just get it out of the way.
What would that be?
Yeah, exactly. Yeah, with the recent pandemic and then the stock price tanking a bit, bearing in mind that it was 357 just a few weeks ago. So it has gone up significantly. People forget that. And I'm very grateful that it's gone up. So thank you to everybody.
It was actually $230 1 year ago. So the stock has tripled in the last year. Good context to have. Even with everything that's happened.
Even with COVID. Like every other car company is down like 50%. So that's what I always try and keep in mind, because I was saying before the show, all the texts that I got from my friends being like, dude, your boy Elon's killing the stock. I'm like, the stock's killing it because of Elon. Like, you guys should look at the chart.
Yeah, exactly. So just curious about your take on, what sort of misconceptions you see about the situation right now with Elon's tweets and the stock and the market in general. So just like to hear your overall thoughts there.
For sure. I mean, I think people that have followed Tesla for a long time understand that this is nothing new from Elon. So when he tweeted that, I've been a shareholder since 2013. So, I've seen this quite a few times. So when I saw that tweet, first thing that came to mind was just how many other times that we've seen this from Elon. So I did some research. In half an hour, I found 5 other times that he has said almost the exact same thing, starting back in 2013. So back in like August 2013, I'll read a quote here. I won't go through all of them, but he says, quote, "I really think the valuation we've gotten is more than we have any right to deserve, honestly. We need to make sure we knock it out of the park in the coming years." Then he reiterated that in October of 2013, then again 2014, 2017, a couple times in 2017. So like this is nothing new from Elon. He's said this so many different times that it's always kind of funny when he says it again and everyone's like, oh my God, he's been hacked. Like it must be hacked. He would never say this, even though he said it like pretty consistently historically. So
exactly.
As a shareholder, it's not anything that's concerning for me because if you look back, as Gally was saying, the stock has done very well, despite Elon, at times saying that maybe it was a little bit getting ahead of itself in some ways. And if you look at like traditional valuation metrics, like of course it's more highly valued than sort of the people in its competitive set. So, Tesla's got 30 billion in revenue run rate, roughly around that level. And they're at $130 billion market cap. So they're trading at 4 times sales versus a company, most other automakers are trading probably at like a half a time sales. So Tesla's got like an 8x premium on the other automakers, but for good reason, because as we saw this quarter, Tesla was able to grow revenue by, 30 some percent in a pandemic global situation where other automakers are down, 15, 20%. So that spread is just going to continue and Tesla's going to keep growing into that valuation. But, there's risks to assigning that growth before it actually happens. So, I think that's some of the context that Elon sometimes tries to get across, and maybe that doesn't come across in like a 7-word tweet. But he did follow that up with saying something. I don't have it up in front of me, but he said something like, as always. Yeah, as always, like I think Tesla, great long-term outlook. So, and that's what shareholders are buying it for, is that long-term outlook. Obviously, no one's buying it for returns of capital today because there are none. There's no dividend. There's no buyback. So it's really all about that future growth, and Tesla's extremely well positioned to capture that future growth. So I have my own price target on Tesla. It's higher than the stock is right now. So, I'm going to continue to hold it.
Awesome. Thank you.
We all have like an exit plan on every single stock. So I would like to know, what is your plan on Tesla stock?
Yeah, it's a really good question. I'm not sure I've actually gotten that question before, and it's probably one I should be asking myself a little bit more frequently, but it's so far out.
Yeah, it is.
It's not something I think about super often. For me, just as an investor, my philosophy is really to invest pretty heavily in companies for the long term. So sort of as we just talked about. So sort of my first big investment was in Apple, and I bought that in probably like 2006, and I still hold the shares. So
me too.
14 years later.
14 years.
And that's been obviously a great investment. I bought Tesla in 2013, still have those shares. So for me, it's really when things change where the company is no longer a growth company, because at least at this point in time in my life, that's what I'm looking for from an investment, is that growth. And I believe at this point in time, Tesla's positioned for, another decade of really strong growth. I mean, one of the questions that I submitted to say.com for the earnings call was if Elon could see that, 50% compound annual growth rate continuing for 5 years or 10 years from an automotive unit perspective. And, his answer was yes, like that's what we see. And he'd be shocked with anything below 40%, which I don't think people really understand, like how insane that level of compound growth is for that period of time. Like that would be one of the fastest growing companies in history.
Actually, Mark Spiegel put it really well.
Yeah.
Yes. Tell us Mark's take on this.
Well, way back in the day, I think Tesla had, maybe 30,000 cars delivered that year. And, Mark put out a really negative note saying they think they're going to get 500,000 cars in 2020. That if they achieve 500,000 cars in 2020, no complex product manufacturer has ever grown that fast from a base of $3 billion or more. And of course, now, even with everything in the shutdowns, Tesla has reaffirmed that they're going to be able to do over 500,000 units.
Yeah, from a capacity perspective, at least. Yeah, I remember that note very well. It's sort of famous in the Tesla community.
Yeah, it is.
It's like, thanks, Mark. Like, we agree that is pretty unprecedented.
It's like, yeah, that's a good point. Yeah, nobody has grown that fast.
Yeah. But to present day, like, I think that the growth outlook, it continues. I think Tesla's lead over competitors continues to grow, and especially in the macro environment situation we're in right now, where it's going to be so difficult for those other automakers to even, get by without investing in electric vehicles. I think that just adds pressure for them to, reduce investments in those projects and sets them even further behind. Whereas Tesla's obviously, as that is their core business, they're going to keep advancing it regardless of the macro environment situation. So in this situation, I think the lead only grows for Tesla, and I think the outlook for growth for the next decade is super strong. So, I think in terms of the original question, like, what's the exit strategy for me when that changes, and Tesla sort of, let's say, completed the mission of accelerating the advent of sustainable transportation and sustainable energy, then that's maybe where I'd start to look for, okay, what's the next investment?
Okay, cool. Thank you.
So far, it seems the market was consistently wrong about Tesla, like their ability to get out the Model S out of the door, then their ability to get Fremont up and running, for mass production of Model 3, then Model Y, not to mention all the negativity and skepticism around autopilot or full self-driving. So what goals do you think Tesla has to achieve, or what needs to happen for analysts to stop denying Tesla's incredible lead when it comes to technology, vehicles, and all that stuff?
For sure. I think Tesla's starting to get a little bit more to that point where the market is starting to recognize what they've accomplished and how they're positioned in terms of the marketplace. Over the last couple of years, the argument on the bearish side has been, Tesla's not profitable. They're never going to be profitable. And that once competition decides to put out electric vehicles, they're just going to take that market, and Tesla's, going to go bankrupt. And I think over the last couple of years, it's been pretty significantly proven or invalidated. Competition hasn't shown up. So I think Tesla bulls expected that for a number of different reasons. And then from the fundamental financial perspective, which is really important to Wall Street, probably more important than it is to, growth retail investors, we've seen Tesla start to show profits. I mean, even again, in a global pandemic situation, they, had a $16 million GAAP profit in a seasonally weak Q1 with other headwinds from tax benefit expiring in the US and in Netherlands. So for Wall Street to start acknowledging that Tesla is profitable and that the bankruptcy risk is low, I think that's a big part of why the stock price has, doubled, tripled in the last year. And I think as Tesla continues to show how profitable they can be, and that the demand is there at higher levels of production, then there's going to be more and more acknowledgement of the valuation. I think we're just starting, to see that in the last 6 months, that recognition of what Tesla is capable of.
Thank you, Viv. Thank you, Rob and Viv. Kristen, do you want to ask a question?
Yeah. Have you figured out what the $415 million of CapEx listed at the bottom of the cash flow statement under non-cash investing for Tesla is?
I don't have the cash statement up in front of me, but I'm assuming that's just their CapEx for the quarter. That's what you mean? Mm-hmm. Yeah, so I think that increased a little bit sequentially, but obviously they're building out their production for Model Y and for Model 3 in Gigafactory Shanghai, as well as, starting to lay the groundwork on, I think it's phase 3 is technically the Model Y for Shanghai. So we should be expecting sort of those sequential growths in capital expenditures as Tesla grows, because they're continuing to reinvest heavily in the future. And there's obviously a ton of growth potential left. As we said, that 15% or 50% compound annual growth rate, that implies 4 million vehicles in 2025 and potentially up to 30 million vehicles in 2030. So CapEx is going to keep coming. Tesla needs to keep building out production. And as they do that, they're going to be able to lower the cost of their vehicles. We just saw that in Gigafactory Shanghai, where I think the Model 3 came down by 15%, standard range plus. So despite that dramatic and quick price reduction, Elon said that they still expect good gross margins on that base level vehicle. So my view is that we're just going to continue to see that over time. Tesla's going to continue to grow their scale, and through that generate economies of scale that's going to allow them for lower costs, which, is sort of like this flywheel that gets them into a new segment of the market where they can do even more volume, and it just keeps going from there. So that's kind of the outlook that I have for Tesla. I think that's, that aligns well with what the mission statement of Tesla is, where they want to, basically get as many electric vehicles on the market as they can. So as it relates to CapEx, yeah, I love to see the CapEx because I know that historically Tesla's gotten a really good return on that spend. So the more that they do that, the more that they're going to be able to grow in the future. So I think in the 10Q filing, they said, over the next couple of years, they expect CapEx per year to be $2.5 billion to $3.5 billion. So, if you break that down on a quarterly level, that's $750 million a quarter. So for us to be at 450 or whatever the number is right now, that's just going to continue to grow as Tesla sees good opportunities for investment.
Super exciting.
Yeah, definitely.
Yeah. And I'm also curious on Rob's take on what Tesla's doing in terms of like continuing to spend on growth, because capital expenditures is basically cash that has nothing to do with the money they're making today, but robots for future assembly lines and that sort of stuff. So Tesla is uniquely, like other automakers are all taking back spending, and Tesla on the conference call was very clear in signaling like we will continue spending, like Model Y is on track for 2021 in Shanghai and in Berlin. And I think that's a very different tone than every other automaker is taking. So I'm kind of building into that. My question for Rob is like, how much do you see Tesla continuing to like push on this CapEx front? And we have like 8 billion in cash now. Like, how concerned are we? Like Omar is always saying like Fremont shut down. That's why Elon's so frustrated. Like Tesla's clearly burning money every day that their biggest factory just can't operate. So like, how should we be worried about like how quickly that 8 billion gets burned through? And like, I know maybe the economy opens in 6 months. That's a worst case scenario. And Tesla's like a 2-year cushion. So it's not even close. But how do you like think about those kind of balancing levers?
Yeah, for sure. And we did hear Elon sort of on the conference call talk about how that is a significant risk in terms of Fremont production. That should be acknowledged. So yeah, as you said, every day that they're not producing vehicles, they have to spend, they have fixed costs that are going to come in regardless of how many vehicles they're producing or selling. So, if that went forever, obviously Tesla would eventually go out of business. I think the good thing is that's not going to go forever. I think that's a big part of what Elon has been trying to communicate the last couple of days. I think it is sort of trying to send a message and start sort of a groundswell of support for getting the economy back open in, a safe, at least as safe as we can sort of manner. And Tesla has experience with this from their Shanghai production. Obviously, the outbreak started in China, and Shanghai was down for a couple weeks. I think it was like an additional few days beyond Chinese New Year that they were down for, as that outbreak was sort of there was question marks in the air about it. But they got back to work really quickly, and they put measures in place to make sure that what they were doing was as safe as possible, from temperature checks, making sure that people were at a safe distance from each other, wearing masks, things like that. So, Elon has seen that play out in China, and now production in China is at an all-time high. So obviously it should be with the ramp, but he's seen that play out in China. And, with that experience, it's got to be really frustrating to not be able to implement that in Fremont and get back to producing. And that's frustrating for Elon. It's frustrating for everybody that works at Tesla. It's frustrating for the workers. So I think Elon, he takes all that in, and then it sort of comes out in this way. And probably sometimes he could, be a little bit more cordial about his message or things like that. But that's not Elon. Like, he's just speaking from his heart about how he feels. And I think if you analyze the situation and, you understand the context that he's seen in China, and the context that he feels from his communications with, all of his staff and his workers and things like that, then it makes a lot more sense, sort of his perspective. And I don't necessarily agree with, all of his takes on the coronavirus situation, but it's very understandable, at least where he's coming from with his experience. So I think there were a couple other questions in there in terms of, well, I guess to the point about the shutdown, I expect that Elon pushing for this is going to have an impact, and I think California is going to have to assess, the situation specifically with Tesla, and I expect that at least by June they're allowed to get production back up and running. At least maybe it's not like fully staffed, but at least to some extent. So obviously, with the $8 billion in cash that you mentioned, Gally, they've got plenty of runway for the production shutdown to continue, but I don't expect that it's going to be something that lasts, 6 months, a year, or anything like that. So I'm not too concerned with the cash position because they're in a really good spot. And then on the CapEx, yeah, they're totally, they said that they've taken this opportunity to sort of reevaluate, their plans. And after doing that reevaluation, they've decided to continue to be aggressive and potentially even become more aggressive in this type of environment, because I think they see the opportunity to sort of extend the lead that they have and to continue to advance their mission, which is really what it's all about for Elon. So no surprise there. And then, yeah, to the competition, like Ford, for example, they just had earnings last week and they cut their CapEx guidance from last year. I think it was like $7.5 billion that they spent in CapEx to, $6.5 or $7.5 billion this year. So they're already reducing their spending. No surprise to see that in this macro environment situation. And a lot of that is going to come from the non-essential things that are future things. Like we talked about, CapEx for Tesla right now is based on things that are going to happen in the future, not things that are happening today. So yeah, I really actually do like seeing that spend, because I know that it means Tesla's really still focused on that mission.
So I think one of the most interesting things that kind of surprised people on the earnings release for Q1 was the 25.5% gross margin, which
absolutely.
Zach Kirkhorn noted that, they're ramping Model Y, they're ramping Shanghai Model 3, and typically when you ramp a new product, gross margins are not good or even negative at first. This is actually the first quarter the first time that Tesla's been able to have a new product be profitable in the first quarter of production. So I was wondering where you saw automotive gross margins kind of stabilizing in the current paradigm where they're making cars and selling cars, and maybe also, for you and Gally, where you think the overall gross margins on the business could be long term if they transition away from selling cars into kind of this, service, robo-taxi, car sharing type model in the future.
Sure. So just on the first part of the gross margin, that was the biggest beat for me in terms of what I was expecting, and I think Wall Street the same. Nobody, was modeling for 25.5% gross margin. That's what allowed them to be profitable, versus the Street expectation was a GAAP loss of, almost $300 million. So for them to show a 16 million GAAP profit, that was obviously driven by a couple things. Number one, the automotive gross margin. So as you said, that was 25.5%. Shorts are going to argue that was boosted by regulatory credits. That's totally fair. Tesla sold $350 million of regulatory credits this quarter. So that added, 5.5% roughly to their automotive gross margin. So that's a huge percent. But even if we don't, consider that, and we just look at the automotive gross margin excluding regulatory credits, the Street does model for that. And then they add in, their forecast for regulatory credits separately. So no one's not thinking about that. It's just a matter of, shorts sort of put a spin on that when they can. But the expectation for the non-credit included automotive gross margin was 16.8% from the Street. Tesla's actually came in at 20.0%. So more than 3% higher than what the Street was expecting, that's a huge difference. And as you said, that was driven by really strong early gross margins on Model Y and Gigafactory Shanghai margins already approaching Fremont, despite the fact that in Fremont, Tesla sells the Standard Range Plus, they sell the Long Range Model 3, and they sell the Performance Model 3. In Q1, out of Shanghai, they were only selling the Standard Range Plus Model 3. They've since added it in Q2, but for them to have margins on that opening price point product that are already pretty close to what Fremont has with, that entire mix in there, just speaks to how well Tesla has been able to ramp up in Shanghai, both from, the speed perspective. They broke ground in January of 2019. So in 15 months, they're already at, 150,000 vehicles annualized rate. And they've already, gotten profits to where they were in Fremont, which they've, been building out for obviously like 8 years or something.
And let's not forget, in Q4, automotive gross margins out of Shanghai were negative.
Exactly.
And they're still importing most of the parts from the American supply chain, right? They're bringing in Model 3 parts from the American supply chain. They're obviously wasting money on shipping. This year, they're going to localize almost all of the Model 3 supply chain, and gross margins should only improve from there.
Exactly. So I think what Tesla's going to do with that, and I sort of alluded to this a little bit earlier, the question was, where do you think Tesla's margins can be longer term? If Tesla held the price points that they have now, 35% margins, maybe even 40% margins, definitely attainable in my point of view. I don't think Tesla's ever going to do that. I think Tesla's going to always take that additional gross margin and use that to lower the price of their vehicles so that they can increase volume.
Totally agree.
A lot of analysts have been out with notes this week saying that, okay, Tesla showed great ability to capture gross margin from Q1. So we're going to raise our margin forecast for the future. That's totally not my perspective at all. I think they're just going to lock in a margin at, 25% or so. Yep. And then over time, as margins grow, they're just going to use that to lower the cost. So right now, maybe the Model 3 starts at 38,000. In a year, maybe it's 35,000. A year after that, 32. A year after that, 29,000. And just on down the line until you have, a vehicle, like an awesome electric vehicle with, 220 miles of range for, let's say, $20,000 or something like that, looking a decade out. So maybe you have to factor in inflation. Maybe it's $25,000, but that's, I think, the mission, and totally in line with Tesla's stated goal of advancing sustainable energy. So that's my perspective on the margin thing. The other, I guess, caveat that I would add to that, you ask about full self-driving and sort of an autonomous fleet where it becomes more of a service business. There, it's a little bit less clear to me what the margin outlook is going to be, because you can make an argument that taking that margin doesn't necessarily allow you for more utilization. If you lower the cost of your ride sharing network, it doesn't necessarily mean more people are going to take rides on it if it's already sort of the cheapest, form of transportation. So in that type of a situation, that's sort of the only thing that I could see Tesla allowing to sort of go above that 25% margin. Otherwise, I think they'll just funnel it all into volume until they really can't funnel it to volume anymore.
Yeah, I think that's a really good point. And I think we're starting to see kind of that thinking already. I think they could let gross margins run to maybe, around 30%, let it run a little bit. But as you see by what they're doing in Shanghai, I think they really obviously want to drive volume. I mean, that's their mission from day one is, if we have some cushion in the margins, let's make the cars more affordable and drive volume. And I think their long-term strategy is, if we have a large volume of electric cars at okay margins, we can have a really great high margin business in software and services, things like gaming, things like full self-driving, premium connectivity, where they don't actually have to go out and do the work to sell a car because their existing fleet is generating earnings for them on a consistent basis. And investors, I think, would love that compared to, the volatility of having to make sure that all these cars are sold to generate earnings.
Definitely. Yeah, investors love service businesses. You have the high margin, you have low operating costs. And that's another thing that I think, when people ask that sort of gross margin question, they're not necessarily thinking about. Gross margin funnels down to operating costs and operating margin at the end of the day, which then impacts net income. So, the financial goal of any company is to sort of maximize that net income. That's really what you get to keep at the end of the business cycle. So the higher volume you are, generally there's economies of scale from a fixed cost perspective. You only have to have a certain number of stores and service centers and things like that, superchargers. And the higher you can drive the utilization of those businesses, the better operating leverage you're getting and the better operating margin you're getting. So yeah, maybe Tesla could sell 1 million vehicles per year at 35% gross margin, and then that funnels down into like a 10% operating margin, something like that. But what they could potentially do is grow that to 10 million vehicles per year at a 25% margin, and maybe that actually funnels down to a 15% operating margin. Even though the gross margins are lower, there's more leverage from an operating perspective. So that's really what should be focused on, because that's at the end of the day what matters is how much is falling to the bottom line. And gross margin is sort of just the first step of that. So lower gross margin with more volume and leverage of operating expenses is going to get you to a better place. And I think that, again, aligns super well with Tesla's mission. So it's kind of a win-win.
like looking at Tesla's long-term future, do you think their main source of revenue will slowly start shifting from physical products such as cars, solar, to software and services, similar to what we've seen with Apple in the recent years?
Yeah, it's a super interesting question. I think Omar alluded to it. Like Tesla's got a lot of opportunity there as, sort of being the first one to ship a computer on wheels. And we've seen, their tremendous advancement with Hardware 3. We've seen the capability of the software program. So, Tesla's got all the tools in place to be able to take advantage of things like that. In terms of sort of when it flips, like, I don't know. It really depends on full self-driving, and I don't think anyone, as much as we would like to, has a good handle on when that's going to, actualize to the point where there's literally a robo-taxi that comes and picks you up and there's no driver and you can do, 90% of the routes that you need to do. If that happens in a couple of years, then yeah, like Tesla's revenue is going to flip pretty quickly to more of that service line. But if that takes a little bit longer and maybe that, takes out to 2025 or 2026, then there are going to be little things that add to margins and add to revenue on a software perspective. Like Omar mentioned, the gaming and premium connectivity, things like that.
Insurance is also one of them.
Yeah, that's a great point too.
Insurance is essentially a data service they're offering to brokers. They're offering data on their cars to let them set better rates.
Exactly. And again, Tesla's uniquely positioned there because with the computer on wheels, they can collect that data versus, other cars that don't have as much technology in the vehicles. They just can't get to that. So that's another way that Tesla can leverage that. There are probably other ways too that we haven't even thought of yet. So those are definitely going to be incremental. That's going to help the margin, which, is going to allow Tesla to reduce costs. And whether you put that on the margin line or you put that on the volume line, that just, makes Tesla's outlook long-term look better and better. So, it really just depends sort of when full self-driving happens for, what percent of the business comes from that. But regardless, what's important is that Tesla is best positioned to take advantage of obviously a lot of value from doing things like that. And no one else can really do that. Waymo maybe, but they're at best splitting that value with other OEMs, whereas Tesla's more of a pure play. So it's really tough to see anyone competing with what Tesla's got.
I think you meant Taco Bell.
Taco Bell's got pretty good data leverage, but not to the scale that Tesla's got.
There's a lot of smart people at Taco Bell, It's kind of interesting because Taco Bell, they own data, right? They are the big data, they're the original big data player. And, they're very good at deep learning. So it's very interesting how kind of the current competitive field is kind of played out. And I would also add that the full self-driving subscriptions this year, they're going to do that this year even before FSD launches. So they're definitely starting to turn the crank up on that. Yeah.
That part's interesting. Gene Munster was trying to ask Elon about that. Like when do we see Tesla Network with a human driver where you could actually, go out and pick people up in your Tesla and sort of use autopilot and stuff. But I don't think Elon fully really understood what he was asking, so we didn't really get a good answer on that.
Sometimes he doesn't get the question exactly.
Yeah. So it's still an interesting question. Hopefully someone will ask at some point and Elon will give us more insight. But I think he didn't understand the question because it's not something they're really thinking about a whole lot right now. And to me, like, I understand it from Elon's perspective because the way that he views it is really rapid exponential progress in autonomous capability. So yeah, today we might need a human driver to sort of assist the, Tesla network operations, but that's so temporary. Whereas the progress in autopilots happens so rapidly that we maybe need that for 6 months, but then in 6 months, it's like fully autonomous. So what's even the point of thinking about that if it's a 6-month period of time? Elon thinks in decades, I think. So it's literally nothing. So I think that's why he, doesn't even really understand the question.
Totally. Was there anything else on that call, the earnings call or in the 10Q that took you by surprise or you're like, wow, it's pretty amazing? Or
I mean, for me, the biggest thing was automotive gross margin. Like that just demonstrates Tesla's ability to ramp quickly and profitably. That has, implications for the future because Tesla demonstrated it once. So every time they want to expand from now on, they have that proof of concept. So that's huge for their growth outlook. The second thing that not a lot of people caught is that in the shareholder letter, they said they were actually on pace to deliver more vehicles this quarter in Q1, again, with all these headwinds, not counting the pandemic headwind, but the tax changes and naturally seasonally weak Q1, they said they were on pace to deliver more vehicles in Q1 than Q4, which was their record of 112,000. So they delivered 88,500. They were going to deliver like 25,000 more vehicles if the pandemic hadn't happened. And that's like mind blowing. I was modeling before the pandemic for, maybe 100, 103,000. And if Tesla would have done that, they would have definitely, been even more profitable, probably to the point where they could have been eligible for S&P 500 inclusion. And that would have just been, I think mind blowing to a lot of people. And it just speaks to like how much latent demand there is for the vehicles that Tesla is shipping, for them to be facing those kind of headwinds and to be able to, deliver that sequential growth in a seasonally weak quarter is just, I think a lot of people are not really thinking about what that means. And it means a lot.
That's so true.
So the S&P 500 is kind of fascinating to me. So what more do we need? Is it 4 quarters of profitability, or is there more than that?
Yeah, so it's the trailing 12 months, so last 4 quarters, and it's a little bit unclear because the S&P 500, inclusion guidelines, it says should be profitable, and then it says also the most recent quarter should be profitable. So we kind of have to interpret that as, okay, the last 4 quarters need to be profitable, and then also the most recent quarter needs to be profitable. Maybe there's a chance that without that Tesla could still get in, but Tesla's, I think their last 9 months profitability is, I don't have it in front of me, but it's well over $100 million. So if they can show even $1 of profit in Q2, they would be eligible for inclusion. And potentially, even if they don't, though my understanding is that they would need to show at least that small profitability. The problem is Q2, the shutdown, we don't know. If they get up and running on May 4th, which is not looking likely at this point, then I think they've got a really good shot at showing profit in Q2. If it extends to mid-May or even to June, then that's probably off the table for Q2, unless they, come out with some regulatory credit sales surprise again, where it's, hundreds of millions of dollars. That's always just kind of a wild card.
Yeah,
definitely.
Oh, the other thing that I would mention just on the regulatory credits in the 10Q and in the 10K previously, they acknowledged that they do have $140 million of deferred regulatory credit revenue that has not been recognized yet. They expect to recognize that sometime in the next 12 months from the 10K, which was in February. So sometime in 2020, they should recognize it. So if they do, $350 million of regulatory credits again in Q2, and then also stack on that $140 million of deferred revenue, we might have, $500 million of regulatory credits one of these upcoming quarters. I don't think Tesla gets to pick when they recognize that. I think it's based on whenever the person that they sold or the entity they sold those credits to actually recognizes it on their balance sheet. I think that's when Tesla recognizes it. So, anybody's best guess on when that happens, but if it were to happen in Q2, there could be, significant tailwind from that could drive that profitability, that could drive S&P 500 inclusion, which would, be a good thing for the stock because there are so many different funds that track the S&P 500 that would then need to buy into Tesla shares.
Curious, what do you think your price target would be if they did get into the S&P 500? Just ballpark.
It's a super good question. I don't think anyone really knows. I don't know. I would think maybe 20% bump from that, over a relatively short period of time. It's not going to be in an individual day probably, but with Tesla, who knows? Pretty volatile. Could happen. That could happen on Monday. I don't know, but
it's hard to say. But that's a good example from AMD. They get in the S&P 500. I believe it's around $10 a share, and right now it's like 58.
Wow.
Yeah.
Yeah, I think with AMD, there's probably underlying other positives for sure. But same thing with Twitter. I think when they got in, it was like a 50% increase over, a month or two.
And Twitter got in with 2 profitable quarters, by the way. So it's not always, they don't always 100% stick to the rules. There's a little bit of subjectivity in there.
Just real quick on Twitter, it doesn't need to be all 4 trailing quarters need to be profitable individually. It just needs to be the summation of them. So Twitter did have that. And then their most recent quarter was also profitable. So technically it did meet those guidelines, but again, they're sort of loose. So the point stands of there could be, some exceptions granted, especially with the pandemic situation, like maybe the S&P 500 would be more forgiving in that type of situation. Yeah.
Another thing about the regulatory credits they mentioned on the call was that even though they recorded the revenue in Q1, they haven't actually gotten the money yet. So that could be a tailwind for cash flow in Q2, when they actually get that $350 million, which will be helpful as, they're burning cash.
Absolutely. And I think on the regulatory credits, that's a great point, Omar. And David Einhorn was out again this week asking about accounts receivable. So I think that was something that I think somebody on Twitter asked us about to briefly talk about. I don't know why he's so focused on accounts receivable. That's money that, is paid to Tesla at some point in the future. So it seems like a weird line for like a short seller to be questioning. I understand that, if those accounts receivable weren't accurate or something, then it would look bad for the financials. But I don't know. That's just kind of a rant on me not understanding his questioning of that line. But Zach in the call acknowledged that most of the $354 million of regulatory credits they sold was not yet booked to cash, and that goes into accounts receivable. So that is a big reason why that line increased. So it's right there in front of all of us to make that interpretation. There are probably other underlying factors there, but to see it increase when you have $350 million of credits that you haven't, converted to cash yet, it's not surprising because that goes into accounts receivable. So I don't really understand that line of questioning.
Well, it's typical, the financials are fake when they make a profit, right? The financials are always real when they lose money, right? But when they make a profit, then it's fake.
Tesla lost so much money for so many years. Like, why? If they were faking it, they would have had better. And I think Elon has even said that. Yeah. If they were faking it, like the numbers would be way better. Like, why? It doesn't make any sense.
Yep.
What about the FSD recognition of revenue?
Yes. Good point. So Zach on the call mentioned that we have $600 million of deferred revenue from full self-driving. Tesla in general has about $1.2 billion of deferred revenue. So that comes from full self-driving. It comes from things like free supercharging, other just various elements. So 600 million of that is from full self-driving.
And just software updates in general.
Yes, software updates in general, because, as even with like an iPhone, Apple will have deferred revenue on the sale of an iPhone because they, have to deliver future software updates. So same thing with Tesla. They have deferred revenue on each vehicle they sell, but the majority of it is from that full self-driving option where they're selling that for, $7,000 a pop. And they're only able to recognize right now half of that as revenue. So you've got, $3,500 per vehicle that has chosen that full self-driving option that it does hit the cash statement, but it doesn't hit the actual profitability or the revenue line, meaning it's not showing up in the margins. And as Tesla delivers these features over time, which we're obviously seeing in Q2 with the traffic control and stop sign, we're seeing them be able to recognize more and more of this revenue over time, which is just going to, again, improve margins, which my philosophy is will allow them to lower the entry-level price. So yeah, it's a big tailwind for them as the software capabilities become more advanced. And Elon made a great point too on the call that it's not just the deferred revenue that shows up on the balance sheet. That's for people that have actually already bought the option, but there are a bunch of people out there too that didn't buy the option that, would consider it in the future if it becomes more advanced. So then they can, Tesla can easily say like, okay, this 1 week, because we just shipped this new feature, we're going to let you buy it for, no extra surcharge, even though you didn't buy it originally. Tesla's done things like that in the past. So, they can take advantage of that. He called it deferred potential. And there's a lot of deferred potential there because the majority of people are not opting right now for that full self-driving option. But as it becomes more advanced, like why would you not? Especially if it can make you money. Not everyone's interested in Ubering out their car, but certainly a lot more people than what have bought the full self-driving package today are going to take advantage of that. And then as Tesla, again, becomes more advanced in that software, less of that revenue is going to have to be deferred. So that's another tailwind. Like on new sales, they're not going to have to defer as much. So margins naturally improve from that, as do revenues. So yeah, it's a big thing that I think a lot of people aren't necessarily thinking about. If Tesla was able to show all that right now, the business would look, that much better.
Yeah, I think it's going to be pretty amazing what we see at the end of this year. The way Elon put it is high margin, high volume. I mean, by the end of next year, you're going to have Giga Berlin, Giga Shanghai, and Fremont, and they're going to be starting construction of a new American Gigafactory. They're going to have over 1 million units of production capacity. Obviously, the economies of scale are going to help gross margins there. Then you've got a $40,000 car with a $7,000 package on top of it, like 20% of the cost of the whole car, pretty much. And every single person is going to buy that on their car in some form or another, whether it's an FSD subscription or they're going to buy it as the functionality improves. And for the people who've already bought it, they're going to recognize the revenue. So I think in the financials, people are really going to be like, holy shit, what the hell just happened as Tesla ships these features, right? They don't have to do anything. They just ship the feature. They recognize the revenue. More people buy it. They recognize that revenue. Gross margin goes up. I mean, Waymo, let's say they perfect level 5 right now. They don't have a factory, right? Taco Bell. They don't have a factory to make these cars, right? And meanwhile, right. Tesla's, been working for years to mass produce these all over the world. And at the end of this year, when they do the subscriptions around that time, I think that's when we're really going to start to see the effect of this. And people's eyes are going to open wide.
Yeah, I totally agree. And it's fun timing because they're going to start being able to recognize some of this deferred revenue and stuff, and the feature set for autopilot is going to become, really robust and competent right around the time that they're sort of hitting this like inflection point in production where Gigafactory Shanghai is at massive volume with great profitability and Model Y is at massive volume with great profitability because the costs of goods sold on that vehicle are supposed to be identical to Model 3. So you have like 5 different tailwinds that are all supposed to hit within about 6 months. And the amazing thing is Tesla already had an amazing quarter in Q1 where it was facing only headwinds. So like what happens when all of that shifts to all these tailwinds? Like it's going to be pretty mind-blowing. So yeah, another reason I don't agree with Elon that the stock is too high.
And one thing is like right now, FSD in China, they're offering 2 years no interest finance. So you're able to get the FSD in China, you just pay like a fixed monthly for 2 years with no interest. I think it will drive a lot of people to get it. That's huge.
Tesla's totally able to do stuff like that because it's a 100% margin option. Like there's no cost for them to deliver that. Maybe some additional warranty cost, but even over time that should actually lower the warranty cost because theoretically autonomous driving should be safer. So it should benefit the warranty expenses to have people have autonomous driving. So it's just there's so much potential for Tesla to be able to leverage, that however they want to. And obviously in China, we're seeing them do that through financing. Here in the United States, we've seen them, not really take any of those levers yet, but they exist and they're right there for Tesla to pull at any time if they want to. So it's, again, something that people aren't really thinking about.
Another thing that's interesting to note is full self-driving works really well in California. And people outside California are like, okay, this map has an error. Like, it doesn't work as well. They're focusing on California and they're focusing on the United States. In China and Europe, it's just not as good. In Europe, there's also some regulatory restrictions. So they're focusing on America right now, just getting that good. But once they do, they'll be able to focus on China, they'll be able to focus on Europe and really improve it in those areas and see a lot more adoption there.
Definitely. And what's interesting about that is, Tesla's percent of their vehicles delivered in the United States it's pretty close to 50% that are going into California. The good thing about that is that because Tesla is doubling production every year or two, that where California's at right now, because Tesla is growing so rapidly, everywhere else is at that level in a year or two, just because of the amount of vehicles that are coming out. And then California is even farther ahead. So as Tesla gets more and more of the fleet out there collecting data, what California has today, that just becomes, worldwide. And that's what Tesla has that no one else can replicate. Like Waymo has no chance of doing anything like that because they only have, a few hundred or a few thousand vehicles.
600, yeah.
Yeah, and Tesla's going to have 1 million. Like, good luck.
1 million a year.
In a few months, they're going to have 1 million with Autopilot 2.5 or above. And then, from here on out, 1 million a year. So it's just crazy the amount of data they're going to be collecting.
I wanted to talk to Gally about the energy, because I know that it was a loss, but I know that Gally was a little watching him doing the YouTube video, and I was like, I really want Gally to extrapolate that a little bit. Do you have any more to add to the energy with that?
Yeah, I'm curious on Rob's take about that, because that's one thing that Elon Musk has said a lot about. Energy could be as big as cars. The growth rate will exceed that of the automotive business, and then we haven't seen that. And I know it's because they've been cell constrained, pushing that into cars, solar roof, at first it was production, now it's installations. But I'm curious, like, the gross profit has been positive, but when you take in the operating expenses, the energy revenue's probably been energy business has been a huge drag on profitability, and the growth hasn't been there. So I'm curious, like, when do you think that changes? And I know a lot of that's like depending on battery day and what they can tell us there. But for me personally, I think that's one piece of this story that seems like has kind of continually been on like the back burner.
Yeah, it definitely has. I mean, if you would have listened to Elon's comments about that back in, 2017, probably is when the energy business really started to become a thing. You would have projected higher numbers for today, and we're not there yet. And I think you mentioned that's because of cell constraints. Pierre Ferragu, the last analyst to ask a question on the call, basically asked that as like, what's going on with energy? Is this just cell constrained? And if so, why? Why not just, bring up cell production? And I think Drew answered that saying that, they're working on it, and battery day will give us a lot more insight into that. So I think it's something we're all excited about. There's obviously a ton of potential in that business. We've seen, sort of proof of concept with things like the Hornsdale battery project in Australia. So I'm not too concerned about it from like a potential business line. I think it's really, as you said, production constrained right now. And certainly the Q1 numbers were disappointing, but it's a small percent of Tesla's business right now. So it doesn't have much of an impact other than, that potential growth outlook. So yeah, I think it's just kind of a waiting game until Tesla really, hits that inflection point on when they're able to start, in my opinion, producing their own cells. I think they're gonna do that. I think they're gonna continue to partner with people and hopefully help bring those partners along with them. But yeah, right now it's just constrained, I think.
Q1 being winter, I don't think a lot of people are ordering, solar panels for their houses. And Buffalo, isn't it shut down as well in New York?
Mm-hmm. Yeah, it is.
So yeah, there's a lot of that.
But even so, they guided for 50% year over year growth, and year over year, even compared to the winter last year, it was actually declining a lot. I think they'll figure it out personally. It's just sort of waiting to figure their the installation of a solar panel is typically the biggest friction, and I think that's a lot of Solar City even acquired some company. I forget the name of it, but their specialty was in how to install solar panels, and I think that expertise is a lot of what's in the Solar Roof. Is Elon talked about they need 1,000 install crews to do 1,000 a week. That's one a week. So that seems like a lot of manpower. And I feel like they've kind of consistently underestimated how hard the actual scale piece of that, scaling the energy side of it has been. And actually, I kind of had one question on Rob, switching gears a little bit, but was wondering if you could put a guess on the Cybertruck now that we've all had months to process it, going from, okay, what is this thing? Is it ugly or not? To I think we've all realized it's going to sell a lot of them and be a really needle moving product for Tesla. So I'm curious if you could kind of break that down for us and give us an estimate of how many do you think it will sell per year, and what the gross margin would be, and kind of why this could be a real needle mover for Tesla as a company, not just a quirky, cool product.
Yeah, for sure. That's actually something I'm pretty proud of, because I think the night that, we were all at the Cybertruck unveil, and it was a pretty shocking event for that to, see that vehicle drive on stage. But I think when we did our live stream afterwards, that I said, I'm pretty confident that Tesla can do 500,000 vehicles, 500,000 Cybertrucks a year. And I still feel pretty good about that level. The Ford F-150 or the Ford F-Series lineup does, I think 900,000 plus in the US, and I think over 1 million internationally. And I think there are, a handful of other trucks that are within 50% of that level. So Tesla, 500,000 a year would be, I think, the fourth best selling pickup. So I think, if you look at Tesla's market share in the other categories they've been in, they pretty much own 50% of the market. With the Model 3 in the US, that's what they've got, which is pretty crazy for one vehicle. Obviously, usually that's split up between, maybe 5 different vehicles. So more like 20% would be what you'd expect. So if the Cybertruck were to attain that level, we could be looking at 1.5 million or 2 million vehicles. So I think 500,000 plus is actually a pretty conservative target. Obviously, it looks different than a normal pickup, but I think all the functionality is pretty much there. There's maybe, some people need, more of an open truck bed or something like that because they want to put things in over the side. And, Tesla's obviously got, I don't know the technical term for it, but they've got the panels there that, make it more aerodynamic. So that's going to rule out some people that really value that feature of a normal pickup truck. So there are little things like that are maybe going to hamper it a little bit. But I think just in terms of the actual specifications and performance of the vehicle and the value of it and the price point that Tesla is saying that they can hit, there's a huge market out there for the Cybertruck. So yeah, I'm feeling really good about that as a business line. In terms of the margin, it's just consistent with my other thoughts on the business. I think they'll try to hit 25%, and if it's coming in higher than that, I think they'll just bring the cost down and do more volume.
The Cybertruck story is really a battery story if you think about it. Because the reason why why didn't Tesla make a pickup truck as their first car? If pickups are the highest selling vehicle type, why not make a pickup as your first car? Well, the battery technology wasn't good enough. You couldn't put enough battery to power a pickup truck and give it enough range to tow and everything and still hit a price point that consumers would be able to afford. And Tesla's now saying, no, we're going to be able to deliver a Cybertruck with a range up to 500 plus miles, and it's going to start at $40,000. So this is really probably one of the big, obviously the biggest story is what are they announcing at Battery Day that's enabling this product and other products. And going back to the Powerwall thing, it was actually one of the most interesting comments that Drew made on the call, because he said, well, I don't want to give too much away, but if you could lower the cost to spool up a new battery production line with a car, there's all kinds of things that go in a car. The battery is obviously a big part of the cost, but there's, steering wheels, all kind of stuff. With the Powerwall, it's all cells and then like a case around it. So if you can bring down the cost of cells, you could bring down the price of a Powerwall a lot compared to the price of a car. And I think the elasticity of demand on a Powerwall is insanely high, because who needs a Powerwall? Who really needs it? Maybe if you have a blackout area or something, but everybody has the grid already. They already have power. For $7,000, but for $3,000, $2,000, now you start to get into demand for utility scale grid storage. Now you start to get into, home demand. You make renewable a cheaper solution. So really interesting all eyes on Battery Day, I think, and what exactly they've achieved here.
Yeah, and I think that's a really good point. Tesla's sort of playing in a couple different markets, and I think wisely they started off in the consumer market, which isn't necessarily all about, cost benefit analysis. There are a lot of different things about okay, I like how this car looks. You don't care really how a Powerwall looks. Tesla makes them look nice, obviously, but people that are buying that are buying it for the utility of it. When you're buying a car, you're buying utility plus, a lot of other different elements. So Tesla sort of took advantage of consumer psychology, not in a bad way, that's just the consumer business, but took advantage of that to be able to get to scale. And now that we're getting to scale, they can start to actually play in this, more utility-based business where it's really about, okay, what is the return on my investment for a Powerwall? What is the return on my investment for a Tesla Semi? What is my return on investment for this Cybertruck, which I'm going to use as my business vehicle? And Tesla's starting to get to the scale now, as you said, where that flips in a lot of different cases. We've already seen that with the Hornsdale battery project. The energy that they're, storing and using from that battery project is saving them money, and they've already generated a great return on their investment from that. As Tesla brings the cost down, there are more and more projects like that switch flips for. And, Tesla said this in the shareholder letter, they've reached an inflection point in terms of demand, at least for the Megapack, and their interest from, commercial businesses looking to invest in that. It's really just constrained right now. So I think, when you think about more of those utility type of projects for the business, the outlook there is incredibly strong as more and more of these use cases start to make sense, because Tesla's achieved that scale and achieved the cost where that inflection point happens. So yeah, it's super exciting.
Looking at cars, residential solar, commercial solar, batteries. What do you think is the most financially sustainable, but also quickest way for Tesla to become like this massive energy and transport conglomerate? What should they prioritize to get to this point?
Specifically on the energy business, or just like across Tesla's entire lineup, do you mean?
I think, yeah, across the entire lineup. Just to be like this massive transport and energy provider, essentially. Mm-hmm. They're kind of like the Apple of energy, if you want to.
Yeah, I do want to. Yeah, I think that's a great. It's a good analogy. Yeah, it's interesting. I think Tesla's followed a good roadmap. They've started with sort of the higher price vehicles that they were able to take more advantage of that, luxury consumer mindset. And they're slowly working their way down into more of that utility mindset. So I think the path that they've followed so far has made, really good sense. For me, I still think there's a lot of advantage to the vehicle side. There's just a premium that vehicles command because of those, more intangible aspects versus the energy business is straight utilitarian. So in terms of the return that Tesla's getting like per battery cell when they're battery constrained, pretty much by default, it's going to be higher in vehicles. So they really need to eliminate that constraint before they can start to shift those cells to the energy business. And I think that, to Galli's point, is why we've just haven't seen the growth, is because Tesla's just continually been cell constrained. So hopefully Battery Day sort of gives us the key to unlock that constraint. And when that happens, then I think, it's all hands on deck in terms of category expansion, where Tesla can start to grow into different businesses instead of being, so focused on, today it's the Model 3, tomorrow it's the Model Y, next week it's the Cybertruck. I think when they have that unlock, which hopefully Battery Day again provides for us, then they can start to do, and Elon has talked about this in the past, multiple product lines at the same time. We're starting to see a little bit of that with like Gigafactory Shanghai, Model 3 and Model Y at the same time. But I still don't think it's like where Tesla really wants it to be eventually.
When he hasn't even touched it. He's talking about HVAC too, and he hasn't even moved into that yet, which is really exciting.
It is. And I think that makes sense too, because obviously when they're building a civilization on Mars, which is probably a really great way to look at, how fundamentally Elon sort of maps out his business planning. You see it with SpaceX, you see it with Tesla, you see it with the Boring Company. The HVAC thing I think applies there too. Like they obviously need to have systems like that on Mars. So it seems like something that probably will eventually need to be done. Obviously it's going to be different for Mars than it is for Earth, but it's the same sort of physics and stuff still, apply. So
Elon's killing like 5 birds with one stone.
Yeah.
Rob, have you done any sort of analysis on the profitability of like an HVAC type business for Tesla, or would you rather them put the money into something else? What's your take on that?
On what type of business?
On HVAC, like so putting it into
HVAC,
a house. Yeah. I mean,
no, I haven't.
That would be kind of interesting analysis.
It would be, yeah. That would be a good video for Galli or me.
Sure, there you guys go. Make it.
Yeah. No, it's a really good question. I haven't thought much about it just because I think it's, again, as Elon said, it's not really something they can do right now. But yeah, it would be interesting to look at for sure.
My thought on HVAC is this. They want to reduce the cost of going completely renewable. Your car is renewable, your house is renewable. And one way to do that is obviously to reduce the cost of battery. If you can reduce the cost of battery, solar becomes really cheap, wind becomes really cheap. And in kind of the same way that reducing the battery cost helps, if you can make the HVAC more efficient, then that also helps and reduces your need for batteries and ability to power your home sustainably. And Elon even talked about kind of an Apple-like integration where your HVAC is actually integrated with your car. And so it's draining less battery out of your power wall and is able to be more renewable because it actually knows when you're coming home, knows when to heat up and cool down, and can really just integrate all together to give the consumer the best low-cost, completely renewable solution all around.
Yeah, totally. And that brings to mind vehicle to grid, which obviously Tesla hasn't pursued to this point. But I think as we hear more and more about Tesla working towards a 1,000,000-mile powertrain, which would include the battery, they can start to potentially leverage vehicle to grid technology, because really the downfall right now is it just would cause more and more cycles on the vehicle. So you're really, degrading that battery pack quicker, and then you're losing range, which people don't really want from their vehicle. But if Tesla can get that, life cycle up and the degradation down, then vehicle to grid starts to make more and more sense too. And that's just another way that they can add value. And Elon always talks about, we just want this to be like the best value that the customer can buy. Adding vehicle to grid technology adds value. Tesla hasn't done it yet, but I think, long term, I don't know why they wouldn't. So it's just another way that, they're going to make, implement HVAC, implement power walls, implement solar, implement this vehicle to grid technology where you can, store energy when it's not as expensive, use it when it's more expensive. It's just all this, this great sort of ecosystem, to take the Apple analogy that Tesla is developing. And again, it just provides a ton of value. So that's an interesting one to think about too.
And Jeff Don has actually been talking about vehicle to grid a lot.
Mm-hmm. Right. And obviously he's working super closely with Tesla on, developing their battery technology. So it seems like it's got to be on the roadmap at some point.
Rob, I would like to know your opinion about what is your estimate of the Fremont Q2 production number?
Yeah, that's a good question. I wish I had a better estimate. You nailed the Q1, pretty good. Yeah, that was nice. I mean, Elon gave us a hint because he said, we've just produced our millionth vehicle, and that was like in mid-March or something like that. So we could kind of work from that to, get into a production number. And, I did some pretty heavy analysis on what it might look like with the shutdown. So I was pretty fortunate on that one. But Q2, I mean, I think the number I had modeled from Fremont was like 65,000 if they had restarted on May 4th. So it's looking less and less likely like the May 4th date's going to happen. So, if it's June 4th, maybe cut that to, 35,000 or so. And then in Shanghai, vehicle production is probably 3,000 to 4,000 per week on average in Q2. So we're probably looking at maybe 45 to 50,000 there. So we could be looking, even if they restart in June, at maybe production of 80,000 vehicles, then maybe deliveries are in line because we know they have a lot more inventory going in this quarter. They have about 30,000 vehicles in inventory, which they can probably run down to about 10,000. So even if it's June 4th, I mean, maybe we're looking at something like 80,000
to 90,000,
75,000 to 90,000 production, and then deliveries probably in line with that. If it's May 4th, then that comes way up, and we could actually see sequential growth from the 88,500 in Q1, which again, I don't think a lot of people are really anticipating.
Yeah. Thank you.
Mm-hmm. One other thing they mentioned that I thought was interesting was they said that in the second half of the year, they're going to produce a run rate of 200,000 Model 3 from Shanghai. So that means 100,000 Shanghai Model 3 in the second half of the year. And then obviously some contribution in the first half of the year, which means Fremont could probably do at or around, maybe even a little bit less than it did last year. And they could still hit the 500,000 target with the help from Shanghai.
Yeah, exactly. If they restart on May 4th, like pretty much no question in my mind that they hit the 500,000. The Model Y production in Q1, Tesla said was greater than 2,700 vehicles. That was the first 2 quarters of Model 3 production. They said it was more than that. So we know it was more than 2,700, excuse me. The following 3 quarters after Tesla produced those 2,700 Model 3s, they shipped about 90,000 Model 3s. So if we apply that same growth rate to Model Y, the following 3 quarters, pandemic excluded, Tesla would have been well on track to ship more than 100,000 Model Ys from Fremont. And, they should have learned from Model 3, so probably even more than that for the year. So yeah, even Fremont production looks really good. And then if you throw 150,000 vehicles from Shanghai for the year, that's 250,000. Then between, Model 3, if you do 200,000 there, that's well below what they did for Model 3 for Fremont for 2019. So yeah, they were totally well on track for that guidance. I think they probably could have done 600,000 plus without this pandemic, but we'll just have to see when production restarts.
Yeah, there actually was a question from Twitter from one of our Patreon subscribers, and thank you to all our Patreon subs out there. I really appreciate you guys. This is from Elon's brain, and he was asking about the profit or the money that they make in Shanghai, for example. They're able to apply those profits to loans in the U.S., like repayments or investments back into Gigafactory 1, for example. I mean, how does it work with the flow there? Is there any restriction?
I would expect that they probably wouldn't convert the currency. I think they'll probably keep it localized to China because I think they're going to continue to invest heavily in China. So to convert it to, the US dollar probably doesn't make a whole lot of sense. While it benefits overall their financials, I think they'll probably keep the currency localized as much as they can, because otherwise it's just sort of an inefficient use of capital when they have needs in China as well. So
yeah, that's what I was figuring too. And we really appreciate you coming on, Rob. It's been a real pleasure, and I hope you enjoyed
appreciate you guys having me.
Yeah, it's definitely
Thanks,
awesome
Rob.
to get us all together. I think we should definitely do this more often. So
yeah, for sure.
Had a lot of fun. So, all right, guys. Well, Third Row Tesla signing off. Thank you.
All right, see you guys.